Ladies and gentlemen, good day and welcome to ICICI Bank Limited Q2FY23 Earnings Conference Call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sandeep Bakhshi, Managing Director and Chief Executive Officer, ICICI Bank. Thank you, and over to you, Mr. Bakhshi.
Thank you. Good evening to all of you, and welcome to the ICICI Bank Earnings Call to discuss the results for Q2 of financial year 2023. Joining us today on this call are Anu, Sandeep Batra, Rakesh, Anandya, and Abhinay. The Indian economy has seen a robust recovery from challenges posed by pandemic. However, we are currently experiencing volatility in global economy and financial markets, geopolitical tensions and upward movements in inflation, interest and exchange rates. The authorities have been taking various measures to address the evolving situation. At ICICI Bank, we aim to grow the core operating profit in a risk-calibrated manner through a 360-degree customer-centric approach and by focusing on ecosystems and micro-markets. We continue to operate within our strategic framework and strengthen our franchise, enhance our delivery and servicing capabilities, and expand our technology and digital offerings. Coming to the quarterly performance against this framework. First, growth in the core operating profit in a risk-calibrated manner through the focused pursuit of target market segments. The core operating profit increased by 23.6% year-on-year to 117.65 billion rupees in this quarter. Excluding dividend income from subsidiaries and associates, core operating profit grew by 24.4% year-on-year. The profit after tax grew by 37.1% year-on-year to 75.58 billion rupees in this quarter. Second, further enhancing our strong deposit franchise. Total period-end deposits grew by 11.5% year-on-year at September 30, 2022. During the quarter, average current account deposits increased by 15.5% year-on-year. Average savings account deposits grew by 16% year-on-year. Period-end term deposits grew by 10.5% year-on-year and 4.3% sequentially at September 30, 2022. The liquidity coverage ratio for the quarter was about 127%. Third, growing our loan portfolio in a granular manner with a focus on risk and reward. The retail loan portfolio grew by 24.6% year-on-year and 6% sequentially at September 30, 2022. Including non-fund based outstanding, the retail portfolio was 44.2% of the total portfolio. The business banking portfolio grew by 42.6% year-on-year and 10.8% sequentially. The SME portfolio grew by 26.5% year-on-year and 6.4% sequentially. The growth in SME and business banking portfolios was driven by leveraging our branch network and digital offerings such as InstaBiz and Merchant Stack. The domestic corporate portfolio grew by 23.1% year-on-year and 6.8% sequentially at September 30, 2022, driven by growth across well-rated financial and non-financial corporates. The rural portfolio grew by 11.7% year-on-year and 3.8% sequentially. The domestic loan portfolio grew by 24% year-on-year and 6% sequentially. The overall loan portfolio grew by 22.7% year-on-year and 4.8% sequentially at September 30, 2022. Fourth, leveraging digital across the business. We continue to enhance the digital offerings and platforms to onboard new customers in a seamless manner and provide them end-to-end digital journeys and personalized solutions. These platforms also enable us to do cross-sell and upsell. We have shared some details on our technology and digital offerings in slides 17 to 27 of the investor presentation. Fifth, protecting the balance sheet from potential risks. The net NPA ratio declined to 0.61% at September 30, 2022, from 0.7% at June 30, 2022, and 0.99% at September 30, 2021. During the quarter, there were net additions of 6.05 billion rupees to gross NPAs, excluding write-offs and sales. The provisioning coverage ratio on NPAs was 80.6% at September 30, 2022. The total provisions during the quarter were 16.44 billion rupees, or 14% of the core operating profit and 0.71% of average advances. This includes contingency provision of 15 billion rupees made on a prudent basis. The bank holds contingency provisions of 100 billion rupees, or about 1.1% of total loans as of September 30, 2022. Sixth, maintaining a strong capital base. The capital position of the bank continued to be strong with a CET1 ratio of 16.95%, Tier 1 ratio of 17.51%, and total capital adequacy ratio of 18.27% at September 30, 2022, including profits for H1 2023. Looking ahead, we will continue to grow the core operating profit in a risk-calibrated manner. We'll work as one team by facilitating cross-functional collaboration to tap into the key customer and market segments, enabling 360-degree coverage and increase in wallet share. We will continue to make investments in technology, people, distribution, and building a brand. The principles of fair to customer, fair to bank, and one bank, one team, one ROE will guide our operations. We focus on building a culture where every employee in the bank serves customers with humility and upholds the values of brand ICICI. We aim to be the trusted financial services provider of choice for our customers and deliver sustainable returns to our shareholders. I now hand the call over to Anandya.
Thank you, Sandeep. I will talk about balance sheet growth, credit quality, P&L details, growth in our digital offerings, portfolio trends, and the performance of subsidiaries. Starting with balance sheet growth, Sandeep covered the loan growth across various segments. Coming to the growth across retail products, the mortgage portfolio grew by 20.4% year-on-year and 4.4% sequentially. Auto loans grew by 19% year-on-year and 5.2% sequentially. The commercial vehicles and equipment portfolio grew by 5.6% year-on-year and 0.6% sequentially. Growth in the personal loan and credit card portfolio was 48.8% year-on-year and 11.8% sequentially. This portfolio was 1077.49 billion rupees, or 11.5% of the overall loan book at September 30th, 2022. The overseas loan portfolio in US dollar terms declined by 10.4% year-on-year and 19.4% sequentially at September 30, 2022. The decline in overseas book primarily reflects maturities of the short-term India-linked trade book. The overseas loan portfolio was about 4% of the overall loan book at September 30, 2022. The non-India-linked corporate portfolio declined by 47.4%, or about $387 million on a year-on-year basis. Of the overseas corporate portfolio, about 84% comprises Indian corporates, 7% is overseas corporates with Indian linkage, 4% comprises companies owned by NRIs or PIOs, and the balance 5% is non-India corporates. On the liability side, Sandeep covered the growth in deposits. During the quarter, we also raised long-term infrastructure bonds as well as refinance borrowings from domestic financial institutions. Overseas borrowings declined, reflecting the reduction in assets. Moving on to credit quality, there were net additions of 6.05 billion rupees to gross NPAs in the current quarter compared to 3.82 billion rupees in the previous quarter. The net additions to gross NPAs were 5.93 billion rupees in the retail, rural and business banking portfolios and 0.12 billion rupees in the corporate and SME portfolios. The gross NPA additions were 43.66 billion rupees in the current quarter compared to 58.25 billion rupees in the previous quarter. The gross NPA additions from the retail, rural and business banking portfolio were 36.58 billion rupees and from the corporate and SME portfolio was 7.08 billion rupees. The gross NPA additions from the corporate and SME portfolio include the impact of rupee depreciation on existing foreign currency NPAs. Recoveries and upgrades from gross NPAs, excluding write-offs and sale, were 37.61 billion rupees in the current quarter, compared to 54.43 billion rupees in the previous quarter. There were recoveries and upgrades of 30.65 billion rupees from the retail, rural and business banking portfolio and 6.96 billion rupees from the corporate and SME portfolio. The gross NPAs written off during the quarter were 11.03 billion rupees. The bank sold NPAs worth 0.94 billion rupees on a cash basis in the current quarter, compared to 0.13 billion rupees in the previous quarter. Net NPAs declined by 25.3% year-on-year and 8.4% sequentially to 60.99 billion rupees at September 30th, 2022. The non-fund based outstanding to borrowers classified as non-performing was 35.16 billion rupees as of September 30th, 2022, compared to 36.70 billion rupees as of June 30th, 2022. The bank holds provisions amounting to 20.24 billion rupees as of September 30th, 2022 against this non-fund based outstanding. The total fund-based outstanding to all standard borrowers under resolution as per various guidelines declined to 67.13 billion rupees, or about 0.7% of the total loan portfolio at September 30th, 2022, from 73.76 billion rupees as of June 30th, 2022. Of the total fund-based outstanding under resolution at September 30th, 2022, 47.39 billion rupees was from the retail, rural and business banking portfolio and 19.74 billion rupees was from the corporate and SME portfolio. The bank holds provisions of 20.59 billion rupees against these borrowers, which is higher than the requirement as per RBI guidelines. Moving on to the P&L. Net interest income increased by 26.5% year-on-year to 147.87 billion rupees. The net interest margin was 4.31% in this quarter compared to 4.01% in the previous quarter and 4% in Q2 of last year. The net interest margin was 4.16% in H1 of 2023. There was no impact of interest on income tax refund on the net interest margin in the current quarter. The domestic NIM was at 4.45% this quarter compared to 4.14% in the previous quarter and 4.09% in Q2 last year. The cost of deposits was 3.55% in this quarter compared to 3.46% in the previous quarter. Of the total domestic loans, interest rates on 44% are linked to the repo rate, 5% to other external benchmarks, and 21% to the MCLR and other older benchmarks. The balance 30% of loans have fixed interest rates. The sequential increase in NIM reflects the impact of increase in interest rates on loan yields, while repricing of deposits occurs with a lag. While policy rate hikes effected so far should further reflect in loan yields, we also expect to see the impact of repricing of deposits in future quarters. Non-interest income, excluding treasury income, grew by 16.8% year-on-year to 51.39 billion rupees in Q2 of 2023. Fee income increased by 17.6% year-on-year to 44.8 billion rupees in this quarter. Fees from retail, rural, business banking and SME customers grew by 19% year-on-year and constituted about 79% of the total fees in this quarter. Dividend income from subsidiaries and associates was 6.48 billion rupees in this quarter, compared to 5.83 billion rupees in Q2 of last year. The year-on-year increase in dividend income was due to higher final dividends from ICICI General and final dividend from ICICI Bank UK, offset in part by lower dividends from ICICI AMC and ICICI Securities. On costs, the bank's operating expenses increased by 24.2% year-on-year in this quarter. The employee expenses increased by 21.1% year-on-year. The bank had about 110,000 employees at September 30, 2022. The employee count has increased by about 9,800 in the last 12 months. Non-employee expenses increased by 25.9% year-on-year in this quarter, primarily due to retail business and technology-related expenses. Our branch count has increased by about 340 in the last 12 months, and we had 5,614 branches as of September 30th, 2022. The technology expenses were about 9% of our operating expenses in H1 of this year, compared to about 8.5% in fiscal 2022. The core operating profit increased by 23.6% year-on-year to 117.65 billion rupees in this quarter. Excluding dividend income from subsidiaries and associates, the core operating profit grew by 24.4% year-on-year. There was a treasury loss of 0.85 billion rupees in Q2 compared to a gain of 0.36 billion rupees in Q1 and 3.97 billion rupees in Q2 of the previous year. The total provisions during the quarter were 16.44 billion rupees, or 14.0% of core operating profit and 0.71% of average advances. These include contingency provisions of 15 billion rupees made on a prudent basis. The provisioning coverage on NPAs was 80.6% as of September 30th, 2022. In addition, we hold 20.59 billion rupees on borrowers under resolution. Further, the bank holds contingency provision of 100 billion rupees as of September 30th, 2022. At September 30th, 2022, the total provisions, other than specific provisions on fund-based outstanding to borrowers classified as non-performing, were 200.59 billion rupees, or 2.1% of loans. The profit before tax grew by 39.4% year-on-year to 100.36 billion rupees in this quarter. The tax expense was 24.78 billion rupees in this quarter compared to 16.9 billion rupees in the corresponding quarter last year. The profit after tax grew by 37.1% year-on-year to 75.58 billion rupees in this quarter. The consolidated profit after tax grew by 31.4% year-on-year to 80.07 billion rupees in this quarter. Coming to the growth in digital offerings, leveraging digital and technology across businesses is a key element of our strategy of growing the risk-calibrated core operating profit. We continue to see increasing adoption and usage of our digital platforms from our customers. There have been about 8 million activations of iMobile Pay by non-ICICI Bank account holders as of end September. The value of transactions by non-ICICI Bank account holders in Q2 of this year was 4.4 times the value of transactions in Q2 of last year. The value of credit card spends in the current quarter grew by 4.4% sequentially and 43.1% year-on-year. We saw a healthy growth in retail credit card spend, driven by increase in discretionary spending, higher activation rates through digital onboarding of customers, including Amazon Pay credit cards. During the current quarter, we closed about 817,000 inactive credit cards as per recent RBI guidelines. The bank has issued more than 3.5 million Amazon Pay credit cards since its launch. We have seen about 195,000 registrations from non-ICICI Bank account holders on InstaBiz till September 30th, 2022. The value of financial transactions on InstaBiz grew by about 22.8% year-on-year in the current quarter. We have created more than 20 industry-specific stacks which provide bespoke and purpose-based digital solutions to corporate clients and their ecosystems. Our trade online and trade emerge platforms allow customers to perform most of their trade finance and foreign exchange transactions digitally. About 70% of trade transactions were done digitally in Q2 of this year. The value of transactions through these platforms increased by 70.1% year-on-year in Q2 of this year. We have provided details on our retail, business banking and SME portfolios in slides 34 to 44 of the investor presentation. The loan and non-fund-based outstanding to performing corporate and SME borrowers rated BB and below was 76.38 billion rupees at September 30th, 2022, compared to 82.09 billion rupees at June 30th, 2022, and 127.14 billion rupees as of September 30th, 2021. The amount of 76.38 billion rupees at September 30th, 2022 includes 21.98 billion rupees of outstanding to borrowers under resolution. Other than one account in the power sector where resolution has been implemented as per RBI's COVID-19 resolution framework, the maximum single borrower outstanding in the BB and below portfolio was less than 6 billion rupees at September 30th, 2022. At September 30th, 2022, we held provisions of 8.12 billion rupees on the BB and below portfolio, compared to 8.61 billion rupees at June 30th, 2022. This includes provisions held against borrowers under resolution included in this portfolio. The total outstanding to NBFCs and HFCs was 735.73 billion rupees at September 30th, 2022, compared to 699.72 billion rupees at June 30th, 2022. The total outstanding loans to NBFCs and HFCs were about 8% of our advances at September 30th. The sequential increase in the outstanding to NBFCs and HFCs is mainly due to disbursements to entities having long vintage and entities owned by well-established corporate groups. The builder portfolio, including construction finance, lease rental discounting, term loans and working capital, was 319.63 billion rupees at September 30th, 2022 compared to 275.69 billion rupees at June 30, 2022. The builder portfolio is over 3% of our total loan portfolio. Our portfolio is largely comprises well-established builders, and this is also reflected in the sequential increase in the portfolio. 6.8% of our builder portfolio at September 30th, 2022 was either rated BB and below internally or was classified as non-performing, compared to 8.3% at June 30th, 2022. Finally, on our subsidiaries and key associates, the details of the financial performance of subsidiaries and key associates are covered in slides 48 to 50 and slides 69 to 74 in the investor presentation. The value of new business or VNB margin of ICICI Life increased from 28% in FY 2022 to 31% in H1 of this year. The value of new business increased by 25.1% year-on-year to 10.92 billion rupees in H1 of this year. The annualized premium equivalent grew by 10.1% year-on-year to 35.19 billion rupees in H1 of this year. The profit after tax of ICICI Life in H1 of this year was 3.55 billion rupees compared to 2.59 billion rupees in H1 of last year and 1.99 billion rupees in Q2 of this year compared to 4.45 billion rupees in Q2 last year. The gross direct premium income of ICICI General increased by 17.2% year-on-year to 51.85 billion rupees in Q2 of this year. The combined ratio was 105.1% in Q2 of this year compared to 105.3% in Q2 of last year. The profit after tax grew by 32.2% year-on-year to 5.91 billion rupees in the current quarter. The profit after tax includes reversal of tax provisions of 1.28 billion rupees. Excluding this reversal, profit after tax grew by 3.4% year-on-year in Q2 of this year. The profit after tax of ICICI AMC was 4.06 billion rupees in this quarter compared to 3.83 billion rupees in Q2 of last year. The profit after tax of ICICI Securities as per Ind AS on a consolidated basis was 3 billion rupees in this quarter compared to 3.51 billion rupees in Q2 of last year. ICICI Bank Canada had a profit after tax of 12 million Canadian dollars in this quarter compared to 8.4 million Canadian dollars in Q2 last year and 7.2 million Canadian dollars in Q1 this year. ICICI Bank UK had a profit after tax of $1.5 million this quarter compared to $2 million in Q2 of last year and $3.4 million in Q1 this year. As per Ind AS, ICICI Home Finance had a profit after tax of 0.6 billion rupees in the current quarter compared to 0.46 billion rupees in Q2 of last year and 0.40 billion rupees in Q1 this year. During the quarter, we infused 2.5 billion rupees of equity capital in ICICI Home Finance to strengthen its capital position and support its growth. With this, we conclude our opening remarks and we will now be happy to take your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of Maru Kajania from Nuvama Wealth. Please go ahead.
Hello. Hi. Congratulations.
Thank you.
Yes. So, my first question is on deposit growth in the second half. Obviously, yours is a strong liability franchise, but liquidity is getting tight. HDFC's merger activity will also strengthen in the second half as they run closer to the merger. So how do you see deposit growth panning out? And in terms of further expansion to margin, what is the outlook over the next 4 to 5 quarters?
So on the first part, Maruk, as you know, retail term deposit growth for the system in general was quite soft over the last few quarters, still, the early part of this financial year, given the level to which the deposit rates had gone down. But I think maybe as the retail term deposit rates have started to move up, I think from the first quarter of this year, we have started to see a good traction and momentum in the retail, FD accretion. Having said that, of course, the pace of increase in the retail FD rate has been, much lower than what we have seen in the wholesale deposit market. But I think if we look at, developments over the last couple of weeks, we are seeing, a more accelerated sort of increase in retail FD rates. And therefore, I think we will see, an increase in retail FD inflows as the banking system moves up on the FD rates. So we expect to see, the retail FD deposit growth momentum to continue and to strengthen. On the second part, on margins, I think if we, as I mentioned in the opening remarks, given that 44% of the book of the domestic book is linked to repo, and we will continue to see some benefit on the yield side in terms of the repricing as the repo rate increases. In fact, the last increase, which was of 30th September itself, will have some impact. But we do expect to see funding costs kind of move up, at a quicker pace than what we have seen so far. So net of that, I think, will be the sort of impact on margins. So we'll have to wait and see, how it evolves.
Okay, thanks. And the other thing is, in general, on loan growth and the ability of consumers to wear the hike, right? Loan growth has been very strong amidst rising rates. and it's almost in defiance with the global macro. So are you going to see a slowdown also as a hard landing, or how does it shape? Why is the economy, why are consumers showing so much strength as never seen before and better than expected? Does it continue for 2 to 3 quarters?
So I think, it starts with the fact, as Sandeep mentioned, that the recovery from the pandemic in India has been, quite strong. And that is, evidenced in a number of indicators, whether it is, demand indicators or the resilience and recovery in banks, loan portfolios in terms of the credit performance. So that those are all indicators that, the consumer is in good shape. In terms of the cost of credit, part of what has happened so far is really a reversion to where the rates anyway were pre-pandemic, and during that time, this time, incomes, etc., would have gone up. But, we have to see whether, future rate hikes, the extent of pass-through that happens, and, what impact, if any, that has on the demand. Also, it's a competitive environment, so banks are, offering products to consumers at, rates which they feel consumers will have offtake at.
Okay, thanks a lot. Thank you.
Thank you. The next question is from the line of Saurabh from JP Morgan. Please go ahead. Saurabh, may I request you to unmute your line from me, sir, and go to the question, please? Saurabh, can you hear us?
Am I audible now?
Yes.
Hello? Okay. So just on this contingent provision, is it fair to assume that, you would just target this 2% ROA and effectively that's how the contingent is working, or is there any reason you made this?
No, it's not that way. We are looking at basically, the overall macro environment both globally and in India in terms of risks to growth, the impact of inflation and interest rates, and the geopolitical risk. And we are looking at, broad across our portfolio wherever we feel that the risk markers are higher and some of these risks could manifest. On that basis is how we are looking at the contingent provision.
Okay. Understand. Thank you, sir.
Thank you. The next question is from the line of Krishnan from HDFC Securities. Please go ahead.
Yeah, many thanks. This is more to do with two things. One, we've generally seen an environment where loan pricing has been fairly fast because of EBLR in this case. That's evident. But also what we have observed is that the loan resets are faster. So if the earlier contracted period, this is not just true of ICICI Bank. I wouldn't have probably observed this specifically for ICICI Bank, but the system in general has moved from, say, a quarterly reset to a real-time reset. So the day the RBI moves, immediately a 50 basis points gets passed on. Right? Does the RBI look at the same reset on the way down as well, or do you anticipate that banks can continue to go back and forth between real-time reset and quarterly reset when the rate movement is adverse? Right? So that's the first question. The second question is also about deposit mobilization. The fact is, we're now at nearly an 86% loan to deposit. Given the kind of demand environment you're seeing, could pricing be on the deposit side? Could we catch up on the deposit side pricing? Could that be faster, say, towards the end of the year?
So on your first question, Krishnan, we don't have any real-time resets. So our EBLR or repo-linked loans reset every 3 months. So, so there is no, next month or immediate reset on our, say, home loans, which are linked to EBLR. On the second part, as we spoke, earlier also on this call, that we have seen, more increases in deposit rates more recently than we had seen, or larger increases than we had seen, till, say, broadly till September. So it would be fair to assume that the repricing of deposits will pick up, from here on.
So just on the related thing on the EBLR, right? I mean, it almost seems like if the RBI does say 100 basis points incrementally from here till the terminal, right? All of that 100 gets passed on. This is something we have been trying to clarify from other banks as well. I mean, it would help if you could share your thoughts. Is there any discretion you can exercise if you see risk building up, if you really don't want to kind of break these camels back, right? So would banks be able to exercise any discretion saying that there comes a point beyond which I will absorb this on my P&L rather than pass it out further and increase asset quality risk? Or does that discretion not exist as things stand?
So I think that's hypothetical. I mean, contractually, the borrower is required to sort of the loan resets and at the spread over the EBLRs. One could, if the borrower is able to, for example, look at refinancing at a lower cost from a competing provider, then, that can happen. So they can, exit my loan and, go to a competing provider and take a loan at a lower spread. Or, so that can happen. And, in fact, I guess, as the rates go up, that can also be a factor in how, spreads and margins move.
Great. Thank you.
Thank you. The next question is from the line of Nitin Agarwal from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, everyone, and congratulations on the performance. Two questions. One is again on the provisions, which was touched upon earlier. As a percentage of PPOP, we are tracking significantly lower than the rate that we have talked about in the past. And so core credit costs running negligible now. So how do you see this? How long can this continue, and what will be your strategy in respect to therefore making contingent provisions? Will we continue to provide more contingent provisions as the provisions to PPOP ratio runs slower?
No. So as I explained, in response to Saurabh's question, we are not, working out any percentage of PPOP or anything like that. It is entirely based on an analysis of the factors in the global and Indian environment and the portfolios that we have, where perhaps, risk markers are a little higher than the average portfolio. That is where which we are on a quarterly basis and continuously reviewing from the perspective of making these prudent provisions. In terms of how the specific credit costs will shape up, I think as we have been saying, I mean, for basis our current understanding and expectation in the near term, we would expect them to kind of significantly undershoot, the normalized level. I think the reasons for that are that, we are not seeing really any material NPL development on the corporate side. In fact, we are seeing some recoveries. And on the retail and SME side, we are coming off, the pandemic-related cycle. So we are seeing actually recoveries out of those portfolios as well. And incremental additions are also at well under control. So credit costs, would be, lower than normal for some time.
Right. And secondly, if you can talk about the branch expansion strategy over the medium term, how do you see that? Because competition is talking about a way aggressive branch expansion than this. How are you looking at it? And any implications on the cost ratios? This quarter, the cost ratios have moderated, backed by strong revenues, but how do you see these two things going forward?
So as far as branches are concerned, I think you mentioned we've added about 340 branches in the last 1 year. We've added close to 200 branches in the current 6 months itself, April to September, and this pace of addition is somewhat higher than what we would have done, in the preceding years. But this is based on our own assessment of the market opportunity with, across different markets and micro markets where, new economic nodes or new nodes of, residential development are coming up, and we need to have a physical presence to service that. I think one of the other things that we are also doing, as a strategy is trying to move our colleagues closer to the market. So that also results in, an expansion of the local footprint. I guess we would continue to, expand our branches on this basis. So you would see branch numbers going up over the next couple of quarters as well.
All right. And any color on the cost ratios?
So we, really focus on the pre-provision operating profit, and that naturally requires, an appropriate management of OpEx, in relation to the revenue. Currently, as you rightly said, the revenue environment is pretty strong, and we feel that there is a lot of opportunity for us to grow our business, to expand our franchise, and therefore we continue to invest in that. That's what we would continue to do. And if I think as we have said in the past, if in a quarter or two, cost growth overshoots even revenue growth, we would not worry about it too much. And if we find it to be a sustained thing, we can always make some adjustments. But currently, I think we are looking at investing and expanding the franchise.
So, thanks so much, Anand. This is very helpful.
Thank you. The next question is from the line of Saraj from Laburnum Capital. Please go ahead.
Hello, sir. Thank you for the opportunity. My question is on the contingent provision again. So is there some specific segment of the book we are providing for against in kinds of cycles?
No, we look across the portfolio, so it's quite a broad range of portfolios that we look at.
So I was particularly asking from the SME and business banking segment. Would it be fair to expect this could be hit hard if there was slowdown?
No, so actually that segment has behaved quite well for us. In fact, I would say that, even if we look at the analysis that we had done at the start of the pandemic when the moratorium was on, I think this is one of the segments where the outcomes have probably been a little bit, overall, not, in line or better. But of course, in an environment where there are, if in the environment of, a lot of macro volatility, this could be a segment that will see some vulnerability. But if we, as far as the contingent provisions are concerned, we are looking at a fairly broad range of portfolio.
Okay. Thank you so much, sir. And congratulations for the results and happy Diwali.
Thank you. Happy Diwali.
Thank you. Next question is from the line of Rakesh Kumar from Systematics Group. Please.
Yeah, thanks. Thanks a lot, sir, for the opportunity. So just one question I have. This is related to, when we are now falling interest rate scenario, which is quite far from here, but just to understand what you are thinking about it. The asset quality, trajectory and the EBLR would not be, working as a counter-cyclical thing. So what is our thought process here? Because margin would also, taper off, and with the fall in the interest rate, there would be asset quality issues also coming up. So the EBLR would not help for the system as a whole, I think. So your thoughts on this? Thank you, sir.
I'm not sure I understood the question, but I think that as the repo rate increases, I think the increases so far have been quite well absorbed by the borrowers and have not don't seem to be leading to signs of any higher delinquencies. And we'll have to, of course, keep monitoring as the situation evolves. I don't think that in a falling rate scenario there would be any negative impact on asset quality, if at all. At the margin, risk could be in the rising scenario. From a bank margin perspective, therefore, it's not really in that sense counter-cyclical, because bank margins would also rise in a higher interest rate scenario.
No, sir. Basically, what I was trying to say that, generally what empirical evidences are there that, when we are in a falling interest rate scenario, basically the NPA rise. And when we see the credit growth numbers tapering off and the interest rate cycle coming down, we see asset quality issues. And in those times, because of this EBLR mechanism in place now, loan pricing would also be faster. Until unless we change the benchmark itself, or if we do some changes there within the EBLR. So actually, because of EBLR linkage, we would have adverse impact on loan, credit yield also, and then we would also have, asset quality issues associated with the fall in interest rate. So
I'm not able to draw this. I don't think it's a kind of reverse causation. So typically, in a normal cyclical tightening and loosening of monetary policy, you would not see such an impact. It could happen in a crisis situation, but there it is not. Where, for example, there is a big shock to growth, but it is the shock to growth which causes the NPL, and not the reduction in interest rates, which is also a consequence of the shock to growth. So I think if it's a normal calibrated tightening and then unwinding of monetary policy, this should not happen. But I will sort of hedge by saying that we have not really seen a full cycle under the EBLR pricing regime. So that is something that we have to see how it goes through, both on the way up and the way down, in terms of both margins and credit quality.
Okay.
Thank you. The next question is from the line of Jignesh from Infred Capital. Please go ahead.
Yeah, hi. Am I audible?
Yes.
Yeah. Just one thing I wanted to discuss, similar to what Krishnan was asking earlier. So in this interest rate cycle side, can we assume that at least incrementally on the new loans, not on the existing loans, which is repo linked or the treasury linked loans and all, considering that demand scenario remaining, it becomes little fragile. In that case, can we take a hit on the spreads just to manage the demand? Is that kind of scenario also likely, or the spread generally remains fixed all the time?
So I think that's a function of how the market sort of prices the loans. As we said, it is a competitive market, so it's a decision of each lender basis their strategy and their funding costs as to what spread over the benchmark they offer incremental loans at. And if we look at what has happened so far, in terms of incremental lending, the pricing would have, the pass-through would not have been uniform for all sort of segments of the market, and we'll have to see how that goes along.
Understood. But there is no regulation as such, right, which restricts you to cut down on your spread. That is what I'm trying to understand.
Not really.
If you want to reduce your spread, that is possible.
If I want, yes.
Perfect. That's answered my question. Thanks a lot, sir, and all the best.
Thank you. The next question is from the line of Niranjan from Nomura. Please go ahead.
Hi. Thanks for taking my question. One question was on this contingency provision build-up. Should we look at, or rather, let me rephrase the question. Do you think your ECL model which you supply to RBI and what we are building right now, are they sort of, kind of pretty much similar? Is that how we should look at that number?
Not really. I mean, this is not modeled on the same basis as either as that. But whenever we move to that, we will have to see how to transition this.
Okay. The reason is, if I just go back, last 40, 50 quarters, I think, given that we did not have so much, contingent and floating provisions level, our credit costs have roughly, I think, averaged around maybe 170, 180, excluding some of the high periods. So, is that something we should look at? I mean, because just we are sitting on the other side of the table. So, how should we think about this number?
See, I think we have to, unfortunately, we are not, there is, the environment has been volatile, so we have not seen in that sense, a stable cycle. But my guess is that, given our overall risk appetite on the corporate side, sort of the focus on, granularity and on the retail SME side, the long-term averages may not be, as effective a guide as to the future sort of credit cost. But I think we have to go through, some period of time before we see how that settles.
Okay, fair enough. Second question is, there seem to be some bit of disconnect. When we look at other sectors, other companies talking about, discretionary spends dropping, vis-a-vis, banks sort of, guiding to extremely strong, forecast. How do we rationalize both of these sides, or are we missing something in this whole picture? Is it just inflation which is playing out? And broadly, how in terms of your risk management policies, have you begun tightening some of the screws once again?
So I don't think on the second one that we continuously review and make whatever micro level changes we need to make, but there is no sort of broad brush tightening that we are doing. In terms of the first one, it's difficult to really answer that question. I think from our side, and it's data. For example, if you look at the credit card spend data, which is being published, by at a systemic level, that is showing, the trends in growth. So it's quite transparent in that.
Okay. All right. Yes. Thanks so much.
Thank you. Next question is from the line of Sheshadri Sen from Alchemy Capital. Please go ahead.
Hi, can you hear me?
Sorry, sir, audio is not very clear.
Just give me a second. Is this better?
Yes, sir. Thank you.
Yes. Hi, Anindra. Thanks for taking my question. The first one is on credit cards, and I'm seeing a sharp jump quarter-on-quarter in the credit card outstanding. How are the underlying metrics in terms of revolvers and EMI and transactors behaved over this quarter? Because I know you don't break it out, but just in terms of trend, have there been any significant shifts in the trend given the sharp jump in the overall book?
I think that what happened really was, without getting into numbers, that we saw a pretty strong growth in the retail spend. and some rationalization of corporate spend. So the retail spend growth would probably be, higher than the average, and that is what translates into, a book. So I don't think that there is any real change in the revolver level.
Okay. So both revolver EMI have been largely stable. There's not been any movement in either direction.
Yeah, nothing to call out certainly on the revolver side.
Understood. Thank you. And secondly, I know a couple of people have asked this before, but just want to revisit the cycle in terms of the net interest margin cycle in terms of how it plays out. When do you expect that we are now at the point in cycle where assets are repricing faster than liabilities? That tends to reverse at some point. When do you see, is it, FY24 or sooner than that trend starts to reverse? Or do you think that given your loan mix changes, and I'm seeing your loan book, there's significant acceleration in some of the high segments, that should take care of any reversal that happens at that point?
We'll have to see. I mean, you're absolutely right that, more durable changes in bank margins come from either loan mix or funding mix or, asset quality. But we'll have to see. I mean, I think that as we explained, given the 3-month reset structure, and if you look at the repo rate hikes which have happened and which are expected, there will be, some upward movement of yields even from here on. At some point, the funding costs will catch up. I guess it will happen sometime in the next few quarters.
Okay. Thanks, Anindra, and all the best.
Thank you. Next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, hi. Good evening. Just two questions from my side. First one on the deposit side again. When you look at these CASA balances, especially on the SA side, when you look at the salaried accounts, from a broad perspective, has the average salary at the retail level gone up? If yes, when you look at the numbers, how much would that number look like? Just a ballpark number to understand how much of this interest rate hike can be offset by higher incomes that the consumer is seeing today.
We have not really given such an analysis, Mahesh, so I wouldn't be able to.
But definitely, Mahesh, I think there is
direction, mostly, not so much about specific numbers at least. Sorry.
I was saying, Mahesh, we have not given any data like that, but as you know, I think there's a lot of data which has come out saying that the average salary increase has been in the region of 10% or so. So that will be reflected, for everyone in general.
Yeah. So you would say that the number which is floating around in the public domain broadly reflects what you're seeing as well, or you wouldn't have done that analysis as well? Or
yeah, it will be because that is the actual data which is there, no? So it will reflect.
Okay. So just another question. This one bank, one ROE target that one has, it's been now 3-4 years since we've seen this. How much of attrition how has been the attrition level at the bank? Has it gone up, gone down? If you could just kind of broadly comment about it.
No, so attrition rates in the financial sector over the last 12 to 18 months for all entities, whatever the approach to performance management they may follow, has gone up substantially, and I don't think there is anything idiosyncratic with us.
Okay. Perfect. Thanks.
Thank you very much. I now hand the conference over to Mr. Sandeep Bakhshi for closing comments.
So happy Diwali to everyone, and wishing you the very best. Thank you so much.
Thank you very much. On behalf of ICICI Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.